Well, hello, everybody, and welcome to this special webcast of Surviving 30 Years of Unemployment, Retire and Stay Retired. My name is Damon King. I'm a certified financial planner, professional, and wealth manager with ChappelWood Financial Services. And I also serve as the lead instructor for ChappelWood University, which is the educational branch of ChappelWood Financial. For the next hour, what you are going to experience is a small portion of the larger two-night course that I typically teach called Rock Your Retirement. And part of Rock Your Retirement is income planning, or as I like to call it, surviving 30 years of voluntary unemployment, because that is what retirement is. Retirement is voluntary unemployment. You've chosen to give up your job, no more dedicated paycheck, and now cash flow comes from the paycheck you have created for yourself. But that paycheck doesn't just happen by accident. It takes careful planning, often over many, many decades. So today, what I'm going to take you through are some of the things that you need to consider before you retire and even during retirement. As always, throughout today's course, if you've got any questions, comments, you may use the chat or Q&A buttons down below. If you hover over your little toolbar, you'll see both of those buttons below, and you can submit a question or a comment through either one of those, and I will share it right here live on the broadcast today. And I encourage your questions, especially if I say something that doesn't make sense, or you want more clarification on, or even if you disagree with something I say. That's okay. I don't know everything, and I don't have every answer, but everything that I am going to teach you today, I can promise you, comes from experience. This is not out of a textbook. This comes from our experience here at ChappelWood Financial, where we are investment advisors to millionaires. It comes from our experience with working with high net worth families. And regardless of how many millions of dollars you might have, everybody has the same basic concerns. Okay, and one of the biggest concerns is running out of money. And you might think somebody who's got $10 million, why would they ever worry about running out of money? Well, everything's relative, right? The more money we have, the more money we spend, and usually the more problems and things we need to overcome. So let's go ahead and get started. And as I said, if you have any questions, please submit them, and I will stop and answer those. So what are we going to discuss today? Well, 4 key things. I've got a lot of information that I'm going to be sharing with you, but specifically, what is the number one question that you must be able to answer before you retire? You must have an answer to this question before you retire. Number 2, the key mistake that we often see many retirees make with their savings. Number 3, the types of income producing assets that you should consider owning in your portfolio during retirement. And finally, 4 Social Security mistakes to avoid, plus, of course, your questions answered. Now, I am going to give a little disclaimer here. Those of you that are already members of the ChappelWood family, you're already clients, a lot of this is going to be a refresher for you. You've heard us talk about this for years, okay? You hear about it on our radio show. You probably attended a previous class, one of my previous classes, or we talked about it in our one-on-one meetings. But that's okay. It's always good to refresh and remind yourself why you're doing what you're doing, why you got the plan you have. If you're not yet a member of the ChappelWood family, then maybe some of this today will be new for you, and hopefully give you something new to think about. When you retire, your focus will have to change. Most of your life you have spent in the accumulation phase of your life. You are accumulating wealth, roughly from 22 years of age up to 65 years, okay? So we're talking about a 40+ year period of time. And during that 40+ year period of time, you are primarily preoccupied with what assets should I own to try to build up my wealth as much as I possibly can. And usually that's going to be some combination of a lot of exposure to stocks, maybe some alternatives, and maybe you throw some cryptocurrency in there now. Didn't have that 20 years ago. So basically you're very aggressive throughout life, and you're focused on asset management. What assets do I own to build my wealth? However, when you transition from the accumulation phase of your life to now more of the distribution phase of your life, you will be more focused on sustaining your lifestyle through cash flow management. When you get into retirement, it becomes less about the specific assets you own and more about the cash flow that those assets can generate. Because I'm here to tell you, when you are in your mid to late 60s and you've retired, you're not really going to care how many shares of Google you own. You're not going to care whether or not you own Tesla. You're not going to really care if you've got crypto or real estate or gold or any other asset if the money you need every month is not showing up in your bank account. You're not going to worry about any of that if you don't have the cash to pay your bills, right? So it's very obvious, at least from the experience that we've had with clients, cash flow management is far more important in retirement than asset management. You do need sufficient assets to retire. But to stay retired, you have to have sufficient cash flow. All right. Retirement also expands your definition of what is your portfolio. Most people think of their portfolio as the stocks, bonds, and mutual funds that I own, the assets that I see on my quarterly statement. But your portfolio is everything. It's all of your liquid wealth, especially in retirement, because when you give up that dedicated paycheck and now you have a certain lifestyle to sustain, you want to see where all of your gold is, all of the money that you potentially have to fund that lifestyle. So your portfolio may be worth $1.5 million, but how much cash do you have in the bank? Do you have any CDs or government treasuries or annuities? Do you have any other hard assets like real estate, minerals, things like that? Okay, so retirement forces you to look at the entire picture instead of just this one small portion. And maybe your stocks, bonds, and mutual funds are the biggest proportion of your total, but the other parts are important too. And your gold, like I said, is spread across 4 buckets. And here are your gold buckets. And this is actually a tool that we use with our clients. Okay, in fact, I've got a client file sitting right here. Okay, and I'm going to be meeting with this client later this afternoon, and I've got their gold buckets, showing them, okay, here's how much, last time we got together, here's how much cash you had in the bank, guarantee of principal. Those would be things like CDs. Generally, guarantee of principal means they're safe from any kind of loss. You can't lose any of this money due to market fluctuations. And they're generally going to get you better returns than just straight up cash, like a money market or a savings account. And the kind of assets that you would see there would be something like a CD at your bank, a share certificate at your credit union. Maybe you own US Treasury bonds. Right now, with interest rates being up like they are, we're seeing some phenomenal yields on short-term US Treasuries, very liquid, very safe. You can get 5% on a US Treasury bond ladder, short-term US Treasury bond ladder. It's just crazy, and up until a year or so ago, you weren't getting anything out of treasuries. And then another item that is protected under the guarantee of principal would be a fixed or an indexed annuity, an insurance contract that protects your money. And then later on, at some point of your choosing, you can convert that amount of money into essentially a pension, a stream of serialized payments over the rest of your life. Then your third bucket, you've got stocks, bonds, and mutual funds. So you know what those are: individual stocks and bonds, mutual funds, exchange traded funds, hedge funds. Maybe you've got some other closed-end funds, whatever. And then finally, you've got your other. These are going to be certainly non-cash assets, but this is where you would find things like rental properties that you own. Maybe you own a farm. Maybe you own some gold, other precious metals. Maybe you have artwork. Maybe you do have some cryptocurrency like Bitcoin. Maybe you own a business that's a part of that. Maybe you have an oil well. Your family has some oil wells. Whatever that might be. All of this together equals your liquid wealth. This is not your net worth, because this does not include the value of your primary residence. We're not going to track that. Okay? Your cars are not in here. I'm not tracking the value of life insurance policies on here. I mean, we can, but for the most part, these are assets that if you had to, you would liquidate them to live. what you begin to find when you plot these out, where is my gold? You begin to see what percentage of my money is at risk in the stock market. Do I have 90% of my money at risk of loss in the market? Okay. If it is, then is all of that money very aggressive and it's at risk of great loss? It's also got the potential for great return, but am I at risk of great loss, or is it more moderate to conservative? Do I have any money that's completely protected from any kind of loss? And if I do have some money that's protected from loss, does that allow me to be more aggressive in my third bucket? And certainly, how much cash do I have? We want to make sure that our clients have cash in the bank. You never know when an emergency is going to come up, or when you want to buy a new car, when you want to take a big trip. And it's always great to have cash on hand just to be on the safe side. One thing that we don't track on here, though, is the value of lines of credit that you might have. It is possible. In fact, just this week, I shared on my Wednesday webinar, unlocking the potential of non-cash assets. And you can actually tap the power, the equity in your non-cash assets to create lines of credit for yourself that allow you to borrow against the value of your assets and avoid liquidating them and potentially triggering capital gains taxes. So we may be preconditioned to avoid any kind of debt, but there are some forms of debt, leverage, that can be very powerful. Now, these are some typical questions that we hear all the time from people that listen to our radio show, that have come to my classes, people that come in to talk with us for the first time. Some of the first questions they ask: how much money is enough for me to save in order to retire comfortably? Okay, a lot of people say, well, I'm going to say, my goal is to save $1 million for retirement. Okay, based on what? Why $1 million? Why not 2 million? Why not 5 million? Why just $1 million? Well, because that's what the celebrity radio host said that I should do. Okay. That's not taking into account a lot of different things, but okay. Another one: which assets should I own in retirement? Again, I understand that most of our life is about asset management. Should I pay off my house when I retire? That's a big one. Okay, that's a big question that we get. These are all great questions. I'm not saying they're bad questions. However, in my experience, it's not the most important question that you should ask. It's not the first question that you should consider when you are considering retirement. The number one question that you must be able to answer before you retire is: how much gross monthly income is it going to take to sustain my desired lifestyle in retirement? I'm going to read that again. How much gross monthly income will it take to sustain my desired lifestyle in retirement? You see, that's a totally different question than how much money is enough for me to save in order to retire comfortably. Because my answer to that question is going to be, well, it depends. I have no idea. I mean, how much is it going to take for you to live? $1 million may not be enough. Where do you want to retire? Is your house paid off? Do you have any pre-existing medical conditions that are going to cause your medical bills to be a lot? So it doesn't come down to trying to target a specific amount of money that you should save for retirement. It comes down to targeting a gross income amount that will be able to provide you the lifestyle you want. That's it. That's the most important question that you should be able to answer, because once you have the answer to this question, everything else falls into place. We can back into the amount of money that you should have saved based on your desired lifestyle and accounting for how long you want this money. Okay. Rates of inflation, rates of return, things like that. But this is the most important question. In my experience, this is it. So why the focus on income? Well, because without income, you can't do anything. All right. If you have $5 million in your investments, okay, say you got $5 million and you get your statement and it shows you got $5 million there. You cannot take that statement down to Target or Walmart, load up your basket with, toilet paper and paper towels and food and things like that, go up to the checkout and say, Your total is $157.36. Oh, that's great. Here's my quarterly statement. Just go ahead and liquidate some shares of Facebook. You can't do that, right? If you want to travel, you got to have cash. You want to renovate your house, you got to have cash, or at least cash flow. Maybe you don't have paper money, but you've got cash that you can spend. The only way to access your investment portfolio is to liquidate, right? Or to use a line of credit. But either way, you must create some kind of cash flow. And without it, you don't get to do any of these things. How much money you should have saved and which assets you own should be dictated by your monthly income need. That's what will determine those other things. I liken the idea of choosing assets or trying to target an amount of money to save to an example of if I go to a doctor and the doctor walks in, takes one look at me and prescribes me medication before they even know what the problem is. Okay, choosing assets before knowing what you need those assets to do and specifically generate income in retirement, it's like taking medication before you know what the diagnosis is. That's backward. We need to know what the diagnosis is before we can prescribe treatment. And in retirement, the diagnosis is income. Okay, how much income? For how long? Income planning is the key to surviving retirement. You want to retire and stay retired, you must have a plan for generating the income that you need. And it doesn't all have to come from your investment portfolio. In fact, it really shouldn't. My clients that I worry the least about in terms of whether or not they will run out of money are those that have multiple streams of income. The ability to generate income from different places. Now, I've got plenty of clients who only have Social Security and their investment income, and that's fine. I don't worry about them really either. But I worry less the more streams of income that we have, because that's the name of the game in retirement, cash flow management. The more cash flow you have, the least likely it is that you are going to run out of money. So what are the key pieces of your income plan? Now, again, those of you who are already clients of ChappelWood Financial, you've already got all this, all right? But like I said, it's good that you have a refresher. First of all, what are your baseline sources of income? You're going to have Social Security. Most everybody's going to have Social Security. Perhaps you have a pension. Maybe you have some annuities. Okay, these are considered guaranteed sources of income, either backed by federal government, perhaps state government, or an insurance company. Okay. Now, could these things go away? Sure. Social Security could be abolished or changed. Pension plans can fail. Of course, that's why the government has set up the PBGC, which is the Pension Benefit Guarantee Corporation, so that if there is a pension plan that fails and goes insolvent, the government swoops in and tries to make those people whole. Annuities, which are issued by insurance companies can fold. But usually what happens is when an insurance company does go bankrupt, those contracts don't just poof go away. Some other insurance company usually comes in and buys those up. But when it comes to insurance contracts, whether it's a life insurance, long-term care, an annuity, auto, home, life, it doesn't matter. Always choose an A or A+ rated company. That's my advice. You could probably save money if you go with a lower rated company. You could probably get higher interest on an annuity or cash value life insurance. If you go with a lower rated insurance company, well, risk or reward follows risk, right? And you're taking on more risk that insurance company could fail. Then you're going to look at other income sources. What other sources of income do you have? Maybe you've got some real estate. Many of you on the call today have rent houses, or you've got farms. Perhaps there's a business that you either own or you have some kind of an equity interest and you receive some kind of dividend from that. Perhaps you own minerals, oil, gas, things like that. I know some of you have, you own farmland and, T-Mobile came in and put a cell phone tower on your property and you get paid royalties off of that, rent off of things like that. That would be other income that would come in. Once we know, okay, if I need $8,000 a month gross, and I look at gross numbers because everybody's tax rates are different. It's hard to account for taxes. I mean, for you specifically, we have to. But when we're doing our overall planning, we look at gross numbers, all right? And we roll the cost of taxes into that. So if you need $8,000 a month to fund your lifestyle, and we've got $2,500 a month coming in from Social Security, you got a $1,500 a month pension. Okay, now we're up to $4,000. And now we've got a gap of $4,000 left. Are there any other streams of income to make up that gap? If not, then now I know my investments need to generate $4,000 a month, or at least I'm going to be living off of those investments at the rate of $4,000 a month. And to try to replace some of that, I need to generate some income. What's my time horizon? When I build income plans for clients, I like them to know, and I want to know, that the odds of them getting to at least age 90 are really strong, 75% or better, 80% or better, okay? If you can get to the age of 90 with your investments and your other streams of income based on your desired lifestyle, statistically, you've got a really good shot of not running out of money. We have to make some assumptions in your plan. What will inflation be? What kind of rates of return can we realistically get based upon the amount of risk that you want to take on? And then finally, there's time segmentation. And this is a part that a lot of people get wrong. We're going to talk about this later, but investing your money based on when you actually need it. You don't need all of your money all at the same time. So it makes sense to segment it based on phases of your life for when you'll actually need the money. And I'm going to show you in picture form what that might look like here in just a little bit. As I'll remind you again, if you've got any questions or comments as we go through today, please put those in the Q&A or chat button down below, and I will share your questions here live on the call. So let's look at the impact of inflation. Why is inflation important? Why do we factor inflation into the income plan? Well, over long periods of time, meaning 30 to 50 years, the average rate of inflation is about 3.22%. Now, we all know what inflation is, or maybe you don't. So inflation is a gradual increase in prices. Looks like we do have a question here. Oh, it says here that the chat is disabled. Nate, thank you, Nate. I did not realize that the chat is disabled. That's interesting. Okay, if the chat is disabled, that is my mistake. I'm so sorry for that. So use the Q&A button, ladies and gentlemen. Please use the Q&A. Thank you, Nate, for letting us know. And first of all, I want to give a shout out to Mr. Nate Scott. He is a life coach, business coach in the Jacksonville, Florida area. And so if you are a business owner or you just want to get your life together, look up Mr. Nate Scott, and he is a great friend of ChappelWood Financial. He's been here at our office and has counseled our team and improved our lives. And he's got a great book, Life is Rich, and it's a really good book. I highly encourage you to get it. So thank you, Nate, for letting me know about that. Back to inflation. Inflation averages 3.22% over time. Now, I know here in the last year, inflation has been sky high. About a year ago this time, inflation was hovering around 9.5%. All right. We just got the inflation numbers this week for the month of June 2023, and it actually come down to around 3%. The Fed's target is 2%. So what that tells us is that there are still probably at least 2 more interest rate increases in our future, certainly one later on this month in July, and then potentially another one in September. But inflation, a gradual increase in prices over time, erodes your purchasing power over time. So here's an example. Let's say you've got $500,000. You invest it today over the next 30 years, and you get a 6% annualized return. So a nice moderate growth rate. Okay, nothing flashy, nothing too conservative, 6% annualized for 30 years. At the end of that 30 years, you go out to your mailbox, you open up your statement, and you are going to see that your account balance is $2,871,745, the time value of money. However, That 6% annualized return is not your inflation adjusted rate of return. If we also include the impact of inflation, to what extent does that 3.22% eat away at the 6%? You may see $2.8 million on your investment statement, but in terms of actual purchasing power in today's dollars, so if you equal the amount 30 years from now, equate it to what would it be worth today in terms of what could you actually buy with it, it would equal just $1.18 million in today's dollars. Or to put it another way, at 3.22% inflation, a dollar today will be worth about 41 cents 30 years from now. That is the power of inflation. And if you do not have inflation factored in to your income plan, it's pretty much a worthless plan. It does not account for what you will actually be able to buy. Now, the reality is this: when we income plan, we assume a rate of inflation, and we actually assume pretty high rates of inflation. Between 3 and 3.5%. We do that because we want to stress test your income plan. We want to see what impact will higher rates of inflation have. Realistically, though, your rate of inflation does not stay static throughout your life, just like the amount of money you need every month does not stay static. If you start with a plan that needs $8,000 a month, you're not going to spend $8,000 every month for the rest of your life. In the early years of retirement, you might actually end up spending more. Why? Because that's when you're traveling and fixing up the house and buying a new car because you deserve it, and taking the family on a cruise, and you do all the fun things you want to do. You might spend more. As you get into your 70s, you start to slow down. You're tired of getting on airplanes. You don't want to travel anymore. You've already done all that. So your spending comes down. Then later on, as you get into your 80s, your spending may go back up. Why? Because now you're going to the doctor more. All of your best friends are doctors. Okay. So your spending might actually look something like this. Well, your personal rate of inflation is all dependent on what are you buying at that time. When you're spending more money and you're buying more stuff, your actual personal rate of inflation may be a little bit higher. But as you're spending less, your personal rate of inflation might go lower. Does that make sense? There's a great study out there, and you can go Google this. It's from JP Morgan, and it's called 3 Retirement Spending Surprises. And it's a great survey, a great study that they did. And it talks about this fact that, while we might plan based on a given amount of income that we need every month and a given rate of inflation, the reality is most people's rate of inflation fluctuates over time. And that if you strip out, if you adjust your personal rate of inflation and you strip it out and base it on and try to equalize it over the rest of your life, they found that most people have a personal average rate of inflation over their retirement of just under 2%. That's kind of interesting, I think. So it might be a little bit lower for you, but the point is you've got to factor in. And if I'm going to factor in inflation, I'd rather factor high than too low. Okay. Then you have the impact of longevity. How long are you going to live? 25% of people turning 65 this year will live past the age of 90. 10% of you who make it to 65 this year will live past the age of 95. If you're in a married couple, there's a 50% chance that one of you is going to live to be at least age 90. And ladies, for you, you live longer. Women tend to live longer than men. And as a result, women have a 90% probability of managing their money by themselves at some point. Here's another one. If you make it to the age of 65, you have a 70% probability of needing some kind of long-term care before you pass away. Now, that doesn't necessarily mean it's going to be in a nursing home or assisted living. It could mean that you have a home health aide come in and cook some meals or count out your pills. But the point is that we're living longer. The longer we live, there's more of an opportunity for something in this biomechanical machine that we all walk around in to go wrong, right? And it requires money to take care of it. Just like your vehicle, it requires money to maintain this biomechanical machine. Okay, here's another one, the impact of time segmentation. How I know, a lot of people, I had one guy said, time segmentation, what are we talking about? Are we talking about astrophysics or something? What is this? It's a simple concept. Time segmentation is segmenting your entire nest egg based on when you actually need the money and doing different things with that money. You will not need to use all of your money at any one given point in time. Nobody has to do that. You'll need some of it now, you need some of it in 10 years, you need some of it in 20 and 30 years. It does not make sense to manage money that you need 2 years from now the way that you manage money you need 20 years from now. So what that means is you have an opportunity to manage your money in little buckets based on when you need it. The sooner you need the money, the more conservative and liquid you want that money to be. The farther away that you need the money, you can be more aggressive with it. So that if you have years like last year, 2022, when the market was down 20%, if that aggressive bucket was down 15% for you, you don't like seeing it, it's not fun. However, your advisor will remind you you've got plenty of time for that to recover because you don't need it for 20 years. It's going to be okay. We're not tapping that bucket. You only lose when you sell. Okay? You might see a negative on your statement, but unless you're pulling money out, you haven't lost anything yet. That is why we don't want to put it all in one big bucket, stir it around, hope to God everything comes out okay, and then start taking money out of it. We want to segment it based on when we need it. And a key mistake that we see a lot of people make is with their retirement savings is managing it all the same way. There is a better way, and it looks like this. This is an actual client, and many of you on the call today that are members of the ChappelWood family, this little chart here is pretty familiar to you because you're using it as well. This is an income plan. This is one of our clients, and when he retired, you'll see the little donut right there. It says for this plan, he had $610,000 that we're plugging into this plan. Now, what you don't see on here, which you would see on his gold buckets, he has another 400,000 plus that's sitting over in an indexed annuity, protected money. So he's got over $1 million total. But we plugged 610,000 of that into his investments to generate the income that he needs. And you'll notice that there are different buckets, different phases of life. Phase number one, the blue phase. We put $117,000 in there. Now you'll notice where it says in the 1, 2, 3, 4, the fifth column over from the left, it says distribution phase rate of return. Because each one of these buckets is targeting a different rate of return using different assets, and you have 2 different rates of return for each bucket. There is an accumulation phase rate of return. So while it's growing and we're not using it, we're targeting 1 rate of return. But when the time comes that we need to start using that money, now we want to be safer with it, right? And it has a distribution phase rate of return. You see how complicated this can get. It's really not that complicated, but it goes way beyond just picking 5 or 6 mutual funds and calling it good. So we broke up this account. Phase 1, he's going to use that in years 1 to 3. And we're targeting a rate of return of just 1%. This is an asset class that is very liquid, very safe, but doesn't earn a lot. Mostly cash. That's right. We basically carved off 3 years worth of cash and we put it into a high yield money market account so that he could get to it whenever he wanted. And now we start sending him his monthly distributions. Meanwhile, the rest of the assets are growing. Phase number 2, we're going to start using that in the 4th year of the plan. You'll notice the accumulation phase rate of return is 3%. we have a little bit of cash there, but now we're starting to step up and we've got slightly more aggressive assets. But these are assets that generate good income and they're less volatile than stocks. What are we talking about? Bonds, mostly a big bucket of bonds, high yield bonds, municipal bonds, investment grade corporate bonds, whatever. And all of the income that they're creating gets reinvested. Now, later on, as phase number one begins to get spent down, because he's pulling out the money at a faster rate than 1%. So it does get spent down. We simply take some of that income, that growth from bucket number two, and pour it over into bucket number one. Now you might be asking, well, isn't the goal here to try to live off income only? That's nice. You have to have saved up quite a bit of money to live off of income only. All right. If your average yield on your portfolio is 3 to 4%, but you're pulling out 6 or 7%, the old rule of, well, you're going to pull out 4% in retirement. I'm sorry, but that's an old, outdated rule. I have very few clients that are just pulling out 4% if they're pulling money out at all. I have plenty of clients that don't really pull out any money at all other than required minimum distributions from tax-deferred retirement accounts. But the 4% rule, it's an okay rule of thumb, I guess. But the point is that you have to have a lot of money to generate the kind of income you need to live off of interest alone. So in his case, he is going to spend this principal down, but over a long period of time. In fact, if you look at the very bottom, phase 4, you'll see it says year 20 to 28. This is almost a 30-year plan. The third bucket, phase 3, now you start getting into more aggressive assets, more stocks, but income producing stocks. We're talking dividend stocks. And then finally, phase 4, now we're looking at more aggressive growth stocks. And we're not going to touch that money until the 20th year of the plan. So that's where he's going to get most of his big ups. It's also where he's going to see more of the bigger downs. But over a 20-year period of time, we're really just targeting a 6% rate of return there. What's beautiful about this approach, when you build out an income plan like this and you realize, wow, I'm only targeting 3%, 5%, 6%. What's my overall target return for this entire plan? And it's, 4.5%, 5%. And I've had some clients say, really, Damon, that's all we're going to try to get is 4 or 5%? Or that's all we're going to get? It's like, no. We're working to get much more than that. This isn't a question about what we're going to get. It's a question of what we need to get. There's a big difference between what we want to get, 8 or 9%, versus what's the minimum target that we have to get to not run out of money. In retirement, you are not playing the beat the stock market game. If you are, you're taking on a lot of risk, because to beat the stock market, you have to take on more risk than the stock market. And most of the clients we work with do not want to take on that kind of risk. It is unreasonable to expect that you're going to beat the stock market unless you are willing to take on as much or more risk than the stock market. So that means that in retirement, the game we are playing, which is a much easier game to win, by the way, is don't run out of money. Generate sufficient cash flow. When you keep that as your focus instead of living and dying with the daily movements of the S&P 500, but instead beating my income plan, which is a lot easier to do. Now, when you go on your vacation to Europe and you see that the market had a really bad week, or even if the market has a really bad year, you don't like it, but you don't panic as much when you realize my plan to be successful and not running out of money only requires that I net 5% over the life of my plan. That's a lot easier to do than having to net 10%. I want 10%, I only need 5. And that's what keeps you sane when the market is doing jumping jacks and going crazy, all right? Now, here's another representation of the cash flow that comes from that plan. So these are the investments, But what about the actual cash flow? I already said cash flow is what's important. It's not about the assets as much as the cash flow. Here you see the cash flow, the progression of cash flow over time. And in the first 3 years of his life or his retirement, he took more of the blue money. That's his investment income, okay? But then at age 66, what happens? His baseline income, the gold bar, really jumps up, and now he's pulling less from his investments. What happened? That represents his Social Security coming online. You see, what we were able to do was delay claiming his Social Security until full retirement age so that we didn't decrease his Social Security benefit. And we're going to get into Social Security here in a little bit. But he was going to go ahead and claim Social Security at 63, claim it early, take a reduction, permanent reduction in his benefit. What we were able to show him was, no, we can set aside 3 years of cash to get you to full retirement age. And then when we get there, we'll claim Social Security, get your full benefit, and reduce the pressure on the investments. Now, over time, you'll notice that the amount of money that he's pulling from his investments gets bigger and bigger and bigger. Why? That is the result of inflation. In this plan, 3.5% inflation. You'll see that up at the top there. This is how you build a solid cash flow plan. And your plan will be different, but this is how you do it, or one way to do it, right? I promised I would share with you some income producing assets to consider for your income plan. So we're looking at things like dividend paying stocks, investment grade and high yield bonds, municipal bonds, which I love to own municipal bonds inside of a taxable investment account because the income from municipal bonds is federally tax exempt. You do not pay income taxes on it. You'll pay it at the state level. But if you live in a state like Florida or Texas, where there is no state income tax, municipal bonds is virtually tax-free or tax exempt. You don't pay any taxes on it. So I love muni bond income for tax-free or tax-exempt income, as well as to generate income. Real estate, if you own REITs, things like that in your portfolio. And here's the other thing. Most people, as they get into retirement, they want to be less risky. They want to take on less risk. They dial back on the amount of risk that they take. Well, income, by its very nature, reduces your risk because income is dependable. It is consistent. When something is consistent and dependable, it lowers your fear over its ability to perform. So here's a perfect example. Let's say you buy a stock, one share of stock for $100. You spend $100 on that share. The next day, the stock goes up by a couple dollars. Now you're up money, but then the next day it goes down. And the next day it goes up, and then down, 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 up, up. And the value of that stock is this. It's all over the place. Meanwhile, it pays you a $3 dividend. Stock goes up in price, $3 dividend. Stock goes down, $3 dividend. Stock goes down again, $3 dividend. Stock goes up, $3 dividend. You get the point? When your income plan and your sanity are based on this instead of this, that's what causes anxiety. This is investing for growth, appreciation, and what can go up certainly can go down. This is investing for income. This is dependable, this is consistent, and this turns this into this. When you incorporate income into your portfolio, it automatically reduces the level of risk that you're taking on. And it just so happens that income is something you need in retirement. Isn't it cool how that works out? I love this stuff. I love it. Okay, now let's spend our last little bit here talking about Social Security, because I did share with you that I was going to teach you 4 Social Security mistakes that you should avoid. But let's go over some basics first regarding Social Security. Most people are eligible to claim Social Security at age 62. There are some exceptions, but for most of you, it's going to be the age of 62. That's when you can first claim it. You can delay claiming Social Security as long or all the way up to age 70, and that's the age that you must claim Social Security if you're eligible to claim it at all. Full retirement age is going to be between 66 and 67. depending upon the year that you were born. And your Social Security benefit is going to be based on your 35 highest years of income. So that means the longer you work, and if you constantly are getting raises, then every year you earn more money, you're replacing a year earlier in your life when presumably you didn't earn as much, and you are working yourself into a bigger Social Security benefit. You basically have two choices when you claim Social Security. If you're married, you can claim 100% of whatever your own benefit is, or 50% of your spouse's benefit, again, if you're married. And if you claim before your full retirement age, which is going to be between 66 and 67, you take a permanent reduction in your benefit. If you claim after full retirement age and you delay, you're going to get a permanent increase. It's about a 6% decrease for every year that you claim early ahead of full retirement age, and it's an 8% increase for every year that you delay after full retirement age. Here's a little chart that shows you what your full retirement age is based upon the year that you were born. If you were born in the year 1954, your full retirement age is 66. Every year after 1954, they add 2 months to the full retirement age until you get to the age of 67. So for example, if you were born in 1955, your full retirement age is 66 and 2 months. If you were born in 1956, 66 and 4 months, so on and so forth, all the way up to if you were born in 1960 or later, your full retirement age is 67. So it's very important that you know what your full retirement age is, because that is what will dictate what is what they call your primary insurance amount, or your full retirement amount. And that's the amount that will either go up or down if you claim early or late. Social Security mistake number one, discounting its value. Now, a lot of people say, well, I'm not even counting on Social Security. And I get that. Social Security does have a lot of issues. We are right now in a situation where the amount of taxes collected to fund Social Security is far less than the amount of benefits being paid out. That's because the baby boomers are retiring in more and more numbers, and there aren't enough Gen Xers and Gen Y and millennials and Gen Z and whoever else there are, taxpayers putting money into the system. Regardless, Social Security still accounts for the average retiree about 40% of your income. So it's not an insignificant amount. You shouldn't just pretend like it's not there. That's why it's important to make the best decision that you can. It's a guaranteed income stream that does receive pretty regular cost of living adjustments. In fact, 2023 saw the largest cost of living adjustment for Social Security ever. You combine that with the fact that the Medicare Part B premium went down a few dollars, and you actually had a nice little bump, right? Also, you might have heard Social Security is going bankrupt. No, it's not. Social Security is not going bankrupt. It cannot go bankrupt. Why? Because it's funded by taxes. And the federal government of the United States continues to collect those taxes, specifically payroll taxes. That's what FICA is, okay? People who work, when they get their checks, part of the taxes that are withheld are for Social Security and Medicare. And those taxes go to fund those systems. What is running dry is the so-called trust. This is the account that all the excess taxes collected while the baby boomers were working, all that money went in there, and the benefits being paid out were far less. So what do you do with all of that excess money? You invest it in US Treasury bonds, things like that. In years when the taxes collected did not equal the benefits paid out, you dipped into the trust to bridge the gap. The problem is now we're having to dip into that fund even more, bigger handfuls, to bridge the gap, because the amount of taxes collected are not as much as the benefits being paid out. And that is happening so much that it is projected that if nothing changes with Social Security, that trust fund would run dry sometime in the year 2034. What happens then? It's projected that everybody on Social Security at that time would take a 25% cut in their benefits. So there are some problems. It's not a perfect system, but it has been around for almost 90 years. President Franklin D. Roosevelt signed it into law, and it took effect in the year 1934, 1935, I believe. 1935, I think. So it's important. Mistake number 2 with Social Security, rushing to collect, but then regretting it later. I hear a lot of people say, it's my money and I'm getting it. I don't know what's going to happen. Government could go bankrupt and they could take my bit. I get all that. But just because you can claim doesn't mean that you should. My first answer is when somebody asks me, should I claim Social Security early or when should I claim Social Security? My response is always, well, when you need the income. And if you're eligible for Social Security and you need the income, the cash flow, because again, retirement's about cash flow management. If you need the income, then it's always a good time to take Social Security so long as you're eligible. But if you're still working and you plan to work for several more years, why claim it? All right. Another consideration, how long do you expect to live? Believe it or not, if you live long enough, delaying Social Security can actually result in more lifetime income than claiming early. What impact will claiming Social Security have to your taxable income? Because as you're going to see here in just a moment, your Social Security can be taxable. And that means it can increase your taxable income. If you're taking Social Security and working at the same time, you are increasing your taxable income and potentially increasing your tax rate. So again, why claim it? Why do you need it? I'm not saying that you don't, but I ask the question, why do you need it? You could leave thousands of dollars on the table by claiming early. And here's an example. So there's a branch of Social Security optimization called break-even analysis. And what this attempts to do is to compare the lifetime income you would receive by claiming at different ages. So for example, the orange bar, the orange curve represents claiming at 62, early. The green curve represents claiming at full retirement age. The yellow curve represents delaying to age 70. What you see there is that there are certain points where those lines intersect. Those are the break-even points. So let's look at the orange line and the green line. The intersection point is at age 78. That is the age at which claiming at 67, full retirement age, lifetime income is equivalent to claiming at 62. And then once you live past age 78, you are now receiving more cumulative income. So if everybody in your family lives to be 113 years old and everybody has perfect heart conditions and there's no cancer and there's nothing, and you guys all live long lives, and it's a pretty strong certainty that you're going to live past the age of 78, you leave money on the table by claiming early. You would actually end up with more lifetime income by waiting until full retirement age. So again, just because you can claim doesn't mean you should. It bears doing a little bit of thinking about it and contemplation, talking with your advisor before you make a decision. Because one thing about Social Security, there are a few do-overs. There are a couple, but there aren't very many do-overs when it comes to making a Social Security decision. So you got to get it right, or as right as you can get it, and you want to have all the information. Social Security mistake number 3, not understanding your claiming options. There's the individual benefit, which is based on your 35 highest years of income. There's the spousal benefit, which is equal to 50% of your spouse's benefit. And you take whichever one is higher. You can't have both. You take whichever one is higher. If you are divorced, yes, it is possible to claim a spousal benefit off of your divorced spouse if 50% of their benefit is greater than 100% of yours. You had to be married for at least 10 years, and you cannot have remarried, generally before the age of 60. Then there's the survivor benefit. If you were married for at least 9 months and you're at least 60 years old, it is possible for you to receive a portion of your deceased spouse's benefit. And you can actually go from the personal benefit to the survivor benefit, or the survivor benefit to the personal benefit, and those numbers could be different. That is because the personal and spousal benefit is a totally different bucket of money than the survivor benefit. I strongly encourage you to go visit with a Social Security agent Take your advisor with you before you make a decision, because they can give you all of your options and run through different scenarios. And mistake number 4, getting blindsided by taxes. Up to 85% of your Social Security benefit can be taxed. And it's based upon a calculation called your provisional income. Essentially, the more taxable income you have, the more your Social Security can be taxed. It's not a hard calculation, but it's a little confusing. I'm going to share it with you right now. Your provisional income is going to be influenced by your tax filing status and the sum of 3 numbers. This will determine what percentage of your Social Security may be taxed. The 3 numbers they add together are 50% of whatever your Social Security benefit is, any tax-exempt income you have, like municipal bond income, and all of your other taxable income, basically your adjusted gross income. They add those 3 numbers together, and depending upon your tax filing status, you're single or joint, that's what will determine how much of your Social Security will be taxed. So for example, let's say you file a single tax return. If the sum of those 3 numbers is less than $25,000, 0% of your Social Security will be taxed. If the sum of those 3 numbers is between $25,000 and $34,000, up to 50% of your Social Security benefit can be taxed. And if the sum of those 3 numbers is greater than $34,000, which isn't even $3,000 a month, then up to 85% of your Social Security benefit can be taxed. It's the same basic concept with joint income. Income amounts are a little higher. Looks like we got a question here. Nate has a comment. He says, I believe that an asset that everyone should consider adding to their income plan is starting a home-based business. It can be beneficial for income, taxes, and socially. And then he asked me, what are my thoughts? Financial security. Starting a home-based business can provide an additional source of income during retirement, reducing the risk of outliving your money. Absolutely. Gives you flexibility and independence, diversifying your income streams, leveraging your skills, experience, and your network. So Nate asked me, what are my thoughts on that? And my thoughts are, I am 10 billion 0.99999% on board with that. And here's a great example. I was just meeting with a client yesterday. This client's name is Thad, and he was recently laid off from his job with a pretty big defense company, big defense contractor with the federal government. Got laid off. 6-figure income, instantly cut off like that. They gave him a whopping 3 months of salary severance. Okay, 3 months of salary. Now we calculated that based on their other income that they have coming in, and then how much they need to pull out of that salary, that lump sum. They stuck it in their savings account, and they're pulling out about $1,500 a month. We calculated that that's good for about 16 months worth of income. So he's got a little over a year of cash flow. And now we know that the clock is ticking and how long that clock is going to count down to. So he's actively looking for a job. But one of the things I talked with that about was, don't you have, with this job that you had, you've got a lot of skills and experience, right? He said, yeah. And I said, well, I certainly wouldn't stop looking for a regular W-2 job, but don't discount the possibility that you could start your own business and become a private consultant. And he said, well, Damon, actually, I've already thought about that. And one of the first things I went out and did right after I lost my job, I started an LLC. And I said, yes. When you retire, whether it's because of a job loss or you choose to retire, you don't just suddenly forget everything you've learned over the course of 30 or 40 years. And I love what Nate is saying. Leverage your skills, your experience, and your network. And that's exactly what I encourage Thad to do. You know all these people, you know all this stuff. Put that to good use. Yes, it's a little hard work running your own business. Of course it is. But it doesn't mean that it's impossible. I'm self-employed. Nate is self-employed. Many of you could be self-employed too. Many of you are self-employed. Okay. And Nate says that's why I help professionals move from disruption to freedom, to start before the disruption. So thank you very much for that. Yes, I'm on board of starting your own business, whether it's because of a layoff or due to retirement. I would like to ask your permission if we could go a little bit longer. I have just a few slides. So if you need to jump off, I understand. I want to be respectful of your time, but I also want to finish my presentation and give you the full benefit of this. So if you can hang with me for just a little bit, please hang on here for a little bit longer. Here's a little bit of bonus, the Social Security earnings test. So this goes back to the question that I get, should I claim Social Security early? I generally do not advise my clients to claim, and I don't advise you either, to claim Social Security while you're still working, especially if you're younger than full retirement age. Because when you do that, you are going to get hit with what's called the Social Security earnings test. From age 62 until your full retirement age, if you have earned income, so this is earned income from work, W-2 or 1099 income, from age 62 to full retirement age, $1 will be withheld from your Social Security benefit for every $2 that you earn above $21,240. Now that's the 2023 number. That number gets adjusted every year upward. So 2024, it'll be slightly higher, 21,600, something like that. That's not a lot of money. Most of you on here are earning a lot more than $21,000 if you're still working. So again, it becomes a question of, do you really need the income? Because if your income is $50,000 based on this formula, you virtually wipe out your Social Security benefit. The year that you turn, on January 1st of the year that you turn full retirement age, now they're going to withhold $1 for every $3 that you earn above $56,520. Again, that's a 2023 number. Then, beginning the month, the very first day of the month that you turn full retirement age, even if your birthday is not until the 30th or 31st, the earnings test penalty goes away. And you will eventually get those $1 back, but you don't get it back as a lump sum. It's a prorated amount over the rest of your life added to each one of your Social Security checks. The point is, if you don't need that income, why are you taking it? There may be a valid reason. There are reasons. But generally speaking, in my experience, just taking it because you can, it's not always the best idea. Okay. Part of what we do is help you to remove the emotion from planning for retirement. All right. And taking it because you distrust the government or whatever, often those get into emotional decision making. And usually using your emotions to make financial decisions are that's not a good idea. Even when that decision is to make a charitable contribution to a charity. Usually making a gift to charity is an emotional decision. We give from our emotions. But even then, there is room for logic and reason before you get to any charity. Even if you feel very strongly in your heart about it, you should always research that charity to make sure that they're on the up and up. That number one, they actually are a qualified 501c3 charity, that they have a tax ID number from the Internal Revenue Service. Take a look at their balance sheet. Ask for it. They get audited. They have tax returns. Yes, nonprofit organizations file tax returns. It's called a Form 990. And those are usually publicly available, especially bigger charities. You can go to a website called guidestar.org. You can create a free account and you can actually look up almost any charity out there and you can look for their Form 990, their tax return. You can see how much income they have. What are their fundraising and administrative expenses versus their program expenses? Who sits on their board of directors? Things like that. All right. I will stay on the line here for just a few minutes if there are any questions. I know I threw a lot of information at you. I hope that you enjoyed the information and I hope that you learned something today. I hope that you got something out of that. Let's see here. Dan asks the question, how does a person evaluate the cost and value for a financial advisor, especially if planning using that advisor into all retirement years? It's a great question. As with any professional service, you're going to pay a fee. You guys know that. One way that an advisor should be able to give you what their value is, ask them what's their value proposition. Okay. We have a written value proposition that tells you when you hire us, yes, you're going to pay a fee if we're managing assets for you. But what does that fee get you? It isn't just asset management. There's a whole breakdown. Like we can actually break down this portion of your fee covers this. This portion of your fee covers this. You receive education like this. Okay. You have us in your back pocket for any financial need that you have. One thing you can do is ask that advisor, what are your licenses? What are your certifications? If an advisor, depending upon their licenses, if all they do is sell stocks and bonds, they're probably going to just sell the stocks and bonds and buy and sell them for you, but they may not give you much else. They may not give you a lot of investment advice or guidance on Social Security or Medicare. Ask them who their partners are. Do you have partners that can help me with things like Social Security, Medicare, estate planning, long-term care, taxes? That's one way that you can evaluate the value for the cost. Okay. Now, if all you're looking at is performance in your portfolio, which I know that's how a lot of people measure it. You know, they measure the value of their advisor based on whether their accounts go up or down. I get that. And if that's all you need, well, then maybe you shouldn't pay a lot. But Dan, that's how we help our clients evaluate us. And you know, we let them choose. And if they don't need all that other stuff and all they want is the investments, then we tell people all the time, then, you know, yeah, maybe we're not the best fit for you if that's all you want, because we're full service. We provide a lot of other things. You also want to make sure that people are licensed. Okay. So if you're looking at an advisor, there's a website you can go to. It's called Broker Check. And you can actually type in somebody's name or the name of the company they work for to see if they are properly licensed. And you can see, do they have any red flags against them? Have they been naughty? Or are there any disclaimers or disclosures on their record? That sort of thing. But if you're planning to use an advisor all through your retirement years, I would want to know that that advisor is going to be there for anything I need during retirement. I just had a client today email me a letter they got from their homeowner's insurance company. I do not sell property and casualty insurance. I'm not an expert on property and casualty insurance. But my client trusts us enough and knows, has been conditioned, this is a financial question. I'm going to send it to my advisors at ChappelWood. I review it, get on the phone, let's talk through a strategy. Okay. Another client wants to renovate his house. How do we get the money? Where do we get it from? Well, we've already pulled it from your IRAs. We've already taken the required minimum distributions. You've already been taxed there. I'm going to pull it from your trust account because that's going to help be more tax efficient. That's not 100% taxable. Is your advisor providing other value than just stocks, bonds, and mutual funds? Are they helping you with tax efficiency? Are they helping you to determine what should be in your estate plan? Do they sit and have family meetings with you so that you can share with your heirs, here's what I want, here's what I have, and when the time comes, here are the people that you should talk to about an orderly distribution of assets, things like that. And Nate makes a great comment. The clearer you are about what you value as the client, the better you'll be able to determine objectively who the best fit is. And I agree with that. So when you're interviewing an advisor, be very honest. Share. This is what's important to me. I ask clients all the time, especially people that are meeting me for the first time. What are you looking for? What do you value in a relationship with an advisor? What means the most to you? Often it goes well beyond the quarterly statement. It usually has something to do with communication, education, not talking over my head. I just want to know that someone's going to be there to help me when I have a question. Dan, I hope I wasn't rambling too much. Good. He says, thanks. I hope that did help. You know, I think the biggest thing is you should feel comfortable asking an advisor any question. Okay. Any question. Sometimes when I get asked questions, the answer to that is, you know what? I don't know the answer to that right off the top of my head, but I will get an answer for you. And that's okay. But if an advisor is unwilling to ask a question or keeps talking around a question, that would be a red flag to me. Okay. Do we have any other questions? I'll entertain maybe one or two more questions here. Anybody have any questions? While you're thinking of a question, you can scan that QR code right there. Use your phone, open up your camera, scan that QR code. It'll take you to a page where you can watch a video about us, about ChappelWood Financial. What is it like being a member? What's the ChappelWood experience like? And then if you like what you see and you would like to talk a little bit more, you're not yet a member of the ChappelWood family, but you'd like to learn a little bit more about what that might look like, you can click the button there and you can schedule an opportunity to speak with a member of our team. And we will be happy to share with you what it's like being a member of the ChappelWood family. Well, I don't see any other questions or comments today. So with that, I want to say thank you so much. I hope you enjoyed this today. I will post that on our website. Is the recording available to review? Barry asked that question. Yes, Barry, it will be. So here's where the recording is going to be. As soon as I get off of here, I'll download it and I'm going to upload it to our YouTube channel. And that YouTube channel is called Financial Diva. All right. Now, those of you that are on the call today, when you registered, I got your email address. So I'll send the recording, the link out once it's on our YouTube page to everybody that got registered. That way you don't have to go searching for it. I'll send it out to you guys, and then you can share it with anybody that you believe needs to see this information. So great question, Barry. Yes, I'm going to make the recording available to all of you that were on. You're very welcome. He said thank you. Okay. Thank you so much, everybody. Enjoy the rest of your day. Stay prosperous. And remember, retirement is not about beating the stock market. That would be nice, but retirement is about not running out of money. Keep that as your focus. That will help you to weather these periods of time when the market has a hissy fit and makes you want to rip all your hair out. I don't have much hair left, so I don't have to worry about it. Okay. Let's see. Do we have another question? Perfect. Okay. Yeah. Thanks, Nate. Yes, let's do that. All right. Have a great rest of your week and day, everybody. We'll talk to you soon. Bye-bye.